Same as applies as last time. If anyone's got any questions or if they're having any problems, like technical problems, please let us know, because it might sound different to us. But I'll just reread that question from Mark then, and we'll just go from there. Shall I?
Great. Yeah.
Okay, so he asked, just for a reminder for everyone, so how do you differentiate whether there isn't a solution to a problem because no one has thought of it yet, versus there isn't a solution to the problem because the problem doesn't require solving?
Yeah, so I'd be extremely wary of claiming that no one else has thought of the solution. That means the biggest risk for your startup is that you've invented something that no one wants, rather than improving a service or a process that people do want. I think even Airbnb, it comes down to how specific you're willing to be about the timing of your idea, about what's out there already, and about how you're improving that. So Airbnb didn't claim to be the first company that will allow you to book with someone else other than a hotel, but they were the first online marketplace that allowed you to do that. So they were specific enough to say loads of people want to stay with locals, not hotels. We haven't invented this. It's not a completely new thing, but we think we're the first people who can execute an online marketplace to allow it, scale it. So you can still be innovative without claiming that you're the first person to think of a solution. If anything, I think that kind of shows some naivety as well. So you'd be better off acknowledging what behavior is out there that shows that people are already doing this or want to do this better, and then what innovative thing are you going to do that allows you to do that for them better than anyone else. I'd probably never claim that you were the first person to think of something.
No, that was always something I was always taught from doing like a art degree. They were always like, nothing's original now, but that's not an issue. It's just who does it better.
Yeah, exactly. It's not an issue at all. If anything, it would be great to know that another company had tried something. They'd found a big market, but this is what they'd got wrong, and this is what we're going to do differently to that.
Yeah, definitely. So the third question is from Stephen. So I hope he's back on the call now. But he's asked, so how do you value a startup business realistically? Obviously, if you are trading, you have historic data to work with. You might also have a pipeline, sales, etc. But for a fresh, out-of-the-box business with none of the above to work from, how can you justify valuation and potential sales without it sounding or appearing like pie-in-the-sky stuff?
This is a really good question, Stephen. I actually think it's more of an art than a science, really, at this stage, which is really what you're alluding to. The one thing to definitely not do is just follow every financials with, this is really conservative, by the way, guys, because no one's fallen for that trick. When you're valuing an early stage company, it's either worth nothing, or if it's a technology startup, it could be worth tens of millions, hundreds of millions of pounds. And it's really about finding what's an equitable agreement at this stage that allows an investor to cover their risk in terms of reward. They know all the stats. 90% of these companies fail. A lot of them fail in the first 3 years. A lot of them soak up a lot of money on product development. So in every founder's mind, they're hoping that their company is going to be worth millions and millions and millions. But for investors, for every 9 they invest in, only one's going to pay off. So they need enough skin in the game for it to be worth it to them. So ultimately, it comes down to what value can you agree with investors at this stage that allows them to claim reward, whilst obviously undervaluing the potential of the company. That there's no way around that. Now, the simple answer is if you have multiple competing offers, then you may as well either pick the investor that offers the most strategic advantage that you trust, and then you'll surely come to a good agreement there. Or if valuation's what's most important, leverage them against each other. I think the reality for most businesses, though, that are fresh out the box, like you described, Stephen, is they don't have competing offers, and a lot of the time it's about taking the offer on the table if that's what's there, but working out what do you need it to be in the long term that's fair. And I think it's okay to say to an investor, okay, where we are today, there are things that remain unproven, and I acknowledge that. So you want a valuation of X. We'll agree to that, and that means this amount of equity. But if in 12 months, I've got the company to where I believe it'll be, which is a sales pipeline or a certain milestone has been hit or a certain amount of commercial certainty has been reached, there's no reason that you can't ask for some equity back. I would say my biggest advice to someone who does have an out-the-box business is, asking upfront for a really high valuation. It's very off-putting and risky. We are at Nova happy to negotiate, especially once things have been proven post-investment. But at the beginning, they do all contain so much risk. Most VCs they'll put you in a bracket of risk and they'll have a deal associated to that risk, and there won't be that much necessarily leeway at this stage. But a lot of good investors will allow you to claim some back at later stages if certain things have been hit. To help get you started, there are some benchmarks you can look at. You can look at what happened in the previous years in the UK at seed stage, pre-seed, and even down to idea, and get a feel for what kind of valuations are out there. I don't know if we can share a link anywhere, Megan, but I put one in the answers to the questions, and there's a link we can share somewhere that's got some basic benchmarks for if your idea stage product leading up to the bigger valuations.
Yeah, definitely. We can pop them in the post comments at the post's description after the live has been recorded. So yeah, we can pop anything that Luke says during this live. We'll pop the links in the description.
Wow. To give you some very rough data, I think tech businesses that are idea stage, according to these benchmarks, are typically valued at like 300K. And when they're coming out of kind of validated prototype stage, maybe like 500 to 600K. I think the fact that an early stage out of the business box can even be valued at that is actually pretty interesting. It really is on day one. So it's about finding the right investors long term for you as well, that you think will structure deals fairly and equitably. Founder incentivization is a big thing. Investors know this. You don't have to tell them that you need equity to push through and make this work over a set 5 to 7 year period. So yeah, my advice, if you've got multiple offers, you're in a great position. If you've only got one, try structuring a deal, post things being proven. And if you don't prove those things, then maybe they were right, and you'll come back and reflect on it in a different way.
You know what, that did shock me that fresh out the box businesses could be valued up to 300K. That's crazy, isn't it?
Well, yeah,
I didn't know that.
Crazy.
That's new learning for me. Maybe not others,
no,
but
it is crazy, and that's why the question's so interesting, because you're not looking at previous financials, you're not looking at employment contracts, you're not looking at a lot of the things you would use to value an up and running business. You're purely valuing it between its potential in the future and its risk today. Those are the only two factors. So 300K today is still super high risk, but it could be worth 30 million, and it's just finding balance there between them. I think we've answered Stephen's question. He said perfect, thank you.
Yeah, and I've learned an insight as well, Stephen, so that's a great question. So yes, so we'll go on to the next one now then. So this one was from Paul. So he's asked, any advice for pitching a startup that is likely to be several years away from successful commercialization, i.e. a health tech hardware product that needs to go through numerous rounds of trials and approvals before it's revenue generating? Would you avoid mentioning this or own it?
Yeah, obviously you have to own it. You need to focus on a big part of the pitch is about working out what you need from partners to get you to where you need to get to, and cash and capital is one part of that. But where you can help it, you want an investor who can also help with the other serious milestones that the company needs to hit. If the company's strategy is to go through trials or go through some sort of pre-product validation and then go into the market, you've got to own that. You've got to be upfront, and you've got to hopefully they'll be able to help expedite those sorts of things. And then also focus on what else the company will be doing during this time. Is that it? Are we going to wait for the trials and then we're going to get some sales going and then it's all sequential? Or is this an 18-month opportunity to speak to, if it's health tech hardware, every hospital in the country, we're going to secure a pipeline of X amount for when we go live. You know, we've got a real plan of building interest or validating other concepts, or we've got some light versions of the product that we're going to release to some beta testers. These are all things that the company can be doing during this time. Nobody wants to hear that I'm going to invest today, and then all we're going to do for 18 months is get this validation, and then we're going to go and grow it, unless they themselves know what that pathway is like, and then they know what they're getting into, and they have their own view on how they can support you. Definitely don't shy away from it. And this applies to high growth startups. You know, maybe you need to remove friction to grow very quickly in order to make the ultimate business model work. So you need to be upfront that you don't plan on charging your users until a certain point of critical mass, and own the why behind that. Otherwise, you just, you know, it's a really important part of what you're bringing to the pitch. Like, this is how we're going to get from today to later. Yeah, I can't imagine not bringing that up.
It's just using what you've got at the moment, isn't it, and selling your startup that way. Because, like you said, at an early stage, you like almost going back to Stephen's question. I think it was Stephen's question, where it's like you just, you know, everything's sort of a bit pie in the sky, and you know you don't have much data, but it's proving, you know, what you've got now and why that's important, I guess. Would you say?
Yeah, definitely.
Yeah, didn't want to just be making stuff up there. Okay, so the next question we go on to is Alex's. So he's asked, what is the #1 pitfall to avoid when pitching your startup?
Number one is definitely overcomplicating things. Like,
yeah,
to get excited about an idea, you need to understand the idea, and like those are often two separate things the investor needs to come to. When it's all thrown together and it's difficult to understand, you spend the rest of the meeting pretty frustrated trying to work through what you've just seen. A successful pitch builds a great foundation for the rest of the meeting, and it's all really positive. You can dig deeper, and you leave knowing how you're going to work together. And then I think, you know, I know it's the #1 pitfall, but I think the other thing that's just equally as bad is like really overselling certain areas. You're asking someone for cash to come on a venture with you. So think like, you know, if we were going, you need to be upfront with what the strengths and weaknesses are of the team. And ideally, you're going to leave that meeting with an understanding if they can help you fulfill, complement those strengths and weaknesses. And that's where the term smart money comes in. So people who come in and maybe they're not good at their financial, maybe their business model stuff, they've never done a B2C business model, or they've never been that technical. And you just need to be honest about these things, because you're setting yourself up for a future failure, really, if you claim that these are all really strong areas of the business, and then you're only going to go into diligence and into deep conversations, and you're going to end up wasting your own time. You're better off, if that investor doesn't want to talk to anyone who's not technical, then why waste their time overselling that area of the team or whatever. And that goes for all parts of it. So keep it simple and just be honest with what the strengths and weaknesses are of the company. Most early stage investors are excited about adding value, not just adding cash. And that's really key.
Yeah, definitely. And I think coming at it from like sort of a marketing point of view, obviously I do a lot of copy quite a lot of the time, and there is no harm with keeping things simple. There's no harm in, like, you know, using simple terminology that gets the point across. I think quite often people feel the pressure with like all aspects of the business to convolute things and, you know, make things sorry, I think my signal went funny, but make things sound amazing. But, you know, you'll do so much better if you can just keep it simple and, you know, really hone in what your product is or startup is and get that across first before, you know, simplicity leads to complexity, my life's mantra. Yeah, so the next question, so this one is my question, so I'll be interested to know. So what makes a great startup pitch? So, you know, looking for advice on creating a deck, the story, the vision, you know, what you should and shouldn't do.
Yeah, so I think what separates a great startup pitch from an average startup pitch. It'll combine a real clear story about why the company is doing the things it's doing, why it's chosen now to do the things it's doing, and why these founders are particularly motivated. And it'll intersect that with the more, dry information that typically comes with a pitch. So it's not just like, here's my market slide, look how much research I've done. They'll have told a story about a certain customer type, of the pains it feels and how it's growing, and you'll resonate, and then it'll start explaining, and here's our market size, and this is why it's changing, this is why it's growing, because this happened, or this law changed, or society is now thinking about this differently, or something's become a lot cheaper than it was, and now we can deliver it. So you have this story that emerges, and it intertwines the business strengths within it, and it shows this, everyone loves a story. We need to know why you're doing something to really buy into it. If all you are at this stage is typically an idea or a pre-product, the story is almost the most valuable part of the company in many ways. And I think people go wrong in one or two ways. They either just tell the story and they leave a bunch of the important business information out. And this is like where you get the X Factor type stories often. Or you'll get the very dry, here are my finances, here are my market, here's my business slides like this. You need to intertwine them. I think a great starting point to do that is simply ask yourself, why now? Like, why did this not happen 2 years ago? So what must have changed in the world that you've understood that not as many other people have? And why will it be too late in 2 years? Like, what that adds a real urgency into what you're doing. And it should drive everything you're doing. Like, why is this business model being chosen now? Why is this tech stack being chosen now? That's how you make a great pitch. When it comes to the deck, again, just don't overcomplicate it. Obviously, a nice deck with good branding can be really valuable. I've seen people raise money off just plain and simple decks that much more often than I've seen people raise money off overcomplicated and overly designed decks. So just keep that simple. The final, I guess, tip is that you're pitching and the deck is a supplement. It helps reinforce what you're saying and gives visual prompts to the investor. Do not put all your words on the slide and read it off. Don't expect the slide to raise the money for you. You have to do all those things. So don't worry too much about the deck. Like, it's important, but it's much more important how you describe what you're doing as a company.
Yeah, definitely not a fan of, when you get those presentations so that it's all written what they're saying on the slide, and it's no one wants to see that. No. Yeah, so we're now at the halfway point, guys. So if anyone's got any questions, put them in the comments. We can see them, so we'll get Luke to answer them as we go along. But I'll move on to the next one. But yeah, just pop them in whenever you're ready. So the next one is, let me just check. Okay, nearly skipped one. Okay, so how do startups deal with the risk of getting their ideas stolen when pitching to angel and venture capitalists? Should I ask for an NDA before pitching my idea to them?
Yeah, so common question, and it's a common misconception, really. There's nothing that tells an investor that how naive you are, really, than asking them to sign an NDA before listening to your idea. I don't say that in a harsh world. It's not how they operate, and I'll give you a few reasons why. First of all, you probably shouldn't be worried. If there was value in the transference of ideas, then you'd probably go to the eBay of ideas and you'd be able to buy some to work on. It seems like the only value in ideas is coming up with them and then also coming up with the ability to execute on them. Otherwise, there's no value in me just telling you an idea now. Secondly, hopefully you're pitching a business that really requires a deep understanding of the market and the customer, and you've thought about for a long time and you are well equipped to deal with. If someone can simply hear the idea and replicate it, I would probably think twice before beginning it, and I think any investor wouldn't really be interested in something so indefensible. It might be more something you want to grow yourself, but it might not be like, the scale business. Thirdly, if they sign an NDA with you, but then you agree to not do business together, but let's say you pitched them the physiotherapy market. That VC then decides to back someone else in the physiotherapy market a few months later. It puts them in a tricky position. They probably didn't steal your idea. Someone else will have approached them. But you can see how that might look a little bit suspicious to people. So why put themselves in the risk of signing an NDA for something that, as we've discussed, has really no transferable value? And then the final point is just practicality. It takes 5 to 7 years, at least typically, to successfully launch a startup business. Is a VC or an angel going to drop everything they're doing over the next 5 to 7 years to do this? It's hard enough to get them to fund it when you're going to do all the work, and them funding it without you doing the work is probably not going to happen. And I really think any VC or angel that was going around and stealing ideas, you'd think they would probably not be in business for too long.
Yeah.
If you've got secrets of the trade, if you are Coca-Cola and you've got a recipe, you don't have to tell them. You just tell them, we are Coca-Cola startup and we've got this special recipe. They say, can we see it? We love the company. Then you can ask them to sign an NDA to see something very specific like that, or some technical document. It's really not worth them signing it to hear the initial idea. And if you can't separate in your mind what's trade secret and what's a basic description of the idea so that people can tell other people, get opinions, get feedback, then you're not right to pitch the idea right now. You need to think about it a bit more.
Yeah, definitely. Like you said, the practicality of it as well. You know, if you have a website, you're going to want to be using words to describe your startup, and if you've got this non-disclosure NDA, then that puts you in a tricky position as well. It's just
about it.
Yeah, it just shoots you in the foot. I never really thought of it like in that sort of way. But yeah, so then the next question would be, so when is it appropriate for a founder to pitch an idea or a product to early stage VCs? This probably lends quite nicely into what you just finished.
Yeah, I do think, there's no specifically right answer. It should really be when does the company need to do it and when is it right to do it? And, there's so much variability between an early stage VC. Some of them are happy to meet you early on and coach you, and when you're ready, they'll talk properly. Some of them don't want to see you until a very specific point. So this is about knowing your audience. I think from a point of view of building relationships with VCs, there's early as possible. If you can get them for a coffee and ask them for advice, that's the best place to go rather than straight away asking them for money. I do think it's polite at the very least to be really well thought out when you meet them. Like, you are asking for cash to come on a very early stage venture. People haven't thought it out through much. And this doesn't mean you've got answers for everything. It means you're just very clear what you know and what you don't know. And you're looking for feedback on what you need to show and prove for them to be interested. That's not a difficult meeting to take. But when someone's asking for cash and it feels like they've thought about this in the last month really and pulled it all together, it can be quite frustrating. That goes more for angels probably. Early stage VCs, best thing you can do, try and build a relationship, find out what they're looking for, and try and maybe get a bit of advice off them and try and set up some sort of regular meeting to go through. A lot of them will have programs they'll want you to go through, specific stages. They might not start for a few months. Typically, again, they'll likely meet you for 15 minutes, tell you what you can be working on until then. And they'll probably want you to go through that program. So that really helps in terms of relevance, that that they're looking for you. So when's it appropriate? I think as soon as you've really thought things through, you can start speaking to them. When's it appropriate to ask for money? Again, you've probably had a couple meetings. You've probably found out how they like to receive their pitches, or, do they need to see financial stuff like that?
Yeah. So Stephen's just popped a question in. So I'll just read that to you. So he said, sorry, I'm just reading this a little bit before Stephen, so don't get my words mixed up. So it said, would you say it's easier to obtain investment when you will be producing a physical product? In relation to myself, we are a premium fashion brand, so a lot of our funds raised will be used to produce stock. So therefore, there is an asset in play. Also, I believe we will need 150k to launch, but should I look at a higher amount? Because in my case, the more funds we have, the more we can produce, market ourselves, and accelerate growth. So good question, Stephen.
Two great questions, Stephen. I think, again, it all depends on the investor. Yes, you'll have an asset to sell, but with buying product, you know, that's a fixed cost overhead in many ways that a tech company simply doesn't have. You know, they're building product for a few years and iterating, and whilst product development never stops, you know, you will eventually end up at a part, especially if it's software as a service, with extremely low overhead, high margin business. So it depends on what type of investor you're after. If they've never looked at a tech business before, they'll think it's bonkers. Like, what are you valuing here? There's no assets. There's no, you know, it's crazy. With your business, it's really, is there still a high growth element like a startup, but it requires stock? And I think that's the element where it gets exciting, when you can pin those two things together. Now, raising 150k is very common in the UK, as that's the limit for SEIS, which is the best tax advantage for the investors in the UK for this kind of stuff. Should you raise more or less? It's a very, again, there's almost no golden answer. Whilst you will be able to produce more stock and buy more, are you going to raise more money in the future is a key consideration. Because if you are, then the more you're going to be at the lowest valuation you're ever going to be at this time, hopefully, fingers crossed. So the more money you take, the more equity you give up. So in a way, if you believe that you're going to raise £1 million in 12 months, then raising 150 to prove a sustainable, scalable model so that you can raise $1 million becomes part of the strategy. So the answer would be maybe 150k is fine if you think you can do that. If you don't think you can do that, then try and raise more. But ultimately, it will cost more at this stage because you're as high risk as you can be. In terms of investors and assets and stuff, yeah, I think that's very much about finding the right investor for you guys that understand what it will take to build a high growth and a premium fashion brand. That is probably a combination of like innovative business practice. That's why you're trying to raise money and grow quickly, but also producing stock and holding it. You know, there's loads of massive e-commerce companies that have done extremely well that combine them. So maybe you're looking at that type of investor, and they probably help advise you on the deal. You know, if you find the right investor, they might say, Stephen, you know, you need to raise 400k this round, like, you know, from what we know, and then we're going to do this, and then we're going to do this. So there's an element of, if you're not sure, see if they've worked on anything previously that's had to go through this cycle of validation. What did they do last time? What's their appetite for follow-on? These investors, there's loads of questions you can ask that help determine should you be looking to raise more or less than 150. I think 6 to 9 months runway is good though as well. I think anything less than 6 months runway, you're just putting too much pressure on yourself. Anything more than a year, it's obviously a nice place to be in one way, but you're probably raising potentially a little bit too much money and getting stung, but maybe not, like, but maybe aim between 6 to 12 months runway, whatever that needs to be.
Well, I hope that answered your question, Stephen. Anyway, if it hasn't, if you've got any more comments, just write them in the comments and we'll embellish on Luke's answer a bit more. And the same for anyone else that's watching. If you've got a question, just pop them in the comments, and like Stephen's, we'll get Luke to answer it. But yeah, so I'll crack on with the other ones that we've got anyway. So have we done that one? Yeah, we've done that one. So going on to the next one. So are there any examples of really good startup pitches that I can take a look at?
I mean, there's great startup pitches all over the internet. I think, again, it's difficult to say this is the best one because it's all about what the context of who you're pitching in the market. I really like the Airbnb pitch deck. I think it's really clean, has very clever kind of market validation, like very concise. You know, you get a massive amount of confidence when you read it, but it's very simple. So I really like that one. I think a lot of the stuff that Y Combinator produce in terms of they do like live evaluation of pitches gives you a better idea of how you should structure your own pitch. But ultimately, the best ones are where you get a sense of what the founder's like as well. And that means being confident in your own tone and skin and the own way you speak, and not trying to necessarily just mirror someone else. So yes, watch all the examples you can, but the best thing you can do is own it yourself. And it'd be hard for me to even think about the best pitch I've seen at Nova, because the founders are so different. So in some ways, some of them have produced, brilliant pitches with the ability that they have. So it's more about, yes, look at people who've pitched successfully, look at how clear they are when they speak and how confident they are when they say things they know or say things they don't know. But the best place to keep working is really just practice your own pitch.
Yeah. I think that originality as well, from individual founders, it helps an awful lot. And I guess at the end of the day is what will make you memorable.
Yeah, absolutely. Yeah, absolutely.
So the next one should be, so how long should I take when preparing my pitch?
Great question. I mean, I think a pitch...
Trying to catch you out here.
No, it's a pitch is your latest iteration, or just your latest reflection on the story that you've been telling since the day you started the company to wherever you are today. So anyone who thinks I need to work on a pitch, you really should have been pitching people, quote unquote, probably every day since you started anyway. So when this question comes up, really, I think it's how long should I take when preparing my deck? Because if you're an early stage company, all you've got is the story. So you really should be working on it all the time, both informally. So that means pitching people and picking up on subtle ways you can improve, and also formally actually pitching people and asking them for feedback. And the great thing on that is you don't even need to ask professionals for that advice. You can ask anyone, does this pitch make sense to you? Did it excite you? Do you think I'm the right person to move this forward? And if they answer yes, 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 then you can keep refining it, but you know that it's coming across well. When preparing your deck, it's about knowing your audience. You probably should have a basic 10-slide deck that you update once every month if you're in fundraising mode, and probably you have a sales deck that you could wiggle into on. Don't spend a month working on a deck just to raise money. Like, think of the risk involved for your company. The company's going to spend an entire month trying to raise money off one meeting that we don't know if it's going to go anywhere. So I don't think you have to spend months and thousands of pounds doing it. The most important thing is you're clear when you're speaking. The second thing is it's more important that the company is working on what it needs to be working on, and you're taking meetings with investors and you can prepare documents if they need them. And you've probably got a template slide that helps explain what you're doing. So long answer, you should always prepare in your pitch. Short answer is don't spend all your time doing your deck though, like, if that makes sense.
Yeah, how long do you think you should spend on your deck then?
Well, that's a matter of ability, I think.
Yeah.
If it's crap, then you need to keep working on it. Simple as that. And if you can show it to people without being embarrassed, and it's clear, and you can get at least maybe 5 people to say, yeah, they compliment each other. Yeah, it makes sense. Yeah, you didn't bore the hell out of me. And then it's probably ready. And that's important. Just because it's business, it shouldn't be boring. That's the worst, boring pitch. Ugh.
Yeah, and I think with that as well, it doesn't mean like, to not be boring. You need
Jim Carrey.
No, yeah, exactly. You don't need to be this like you don't need to be like this innocent smoothie sort of like hilarious brand figure, but you can be an emotional brand and not be boring. You can really sell your story in that way and your purpose. Yeah. So then I'll move on to the next one. So how do potential investors decide whether an idea is worth investing in, and when they listen to I've rambled on there. So how do potential investors decide when an idea is worth investing in?
Again, every investor is different. They're probably not deciding during that one pitch if it's worth investing in. They're just building a hypothesis in their mind of what they think they're hearing, what they think might happen in the future. They probably need an amount of time that's difficult for them to estimate, to think about it. They don't often make snap decisions. This is why it's about building a foundation for deeper discussion and conversation. What are they looking for though? I mean, number one, we are all subconsciously kind of judging each other, looking at our body language, working out if this is someone we trust or that we believe what they're saying. So, the first thing is you'll be giving off a natural impression that you need to understand how you're being perceived. And a great pitch convinces investors that you can convince other people, like when they're not there. So before you've even said anything, they're already trying to work you out. And that's human reaction. And then the second thing that, what we look for is if we like the founder, we like their experience, and we like their insight on a market, have they got a good fit with that market? So rather than plan A, are we backing just one plan, or are we backing a series of experiments between this founder and this market that will probably result in a solution that delivers value? And to do that, it's really about, how much do I trust their knowledge, their expertise, what they're saying to me about customers, and that comes from both the content and the delivery and how concise and confident you can be, and also from your own manner and the way you run the meeting. So all of this factors in. And again, a lot of it is more of an art than a science in the early stage. So in a way, don't take it personally. They might not have one specific reason they didn't invest. It might not have just given them the right feeling on the day. It's, they're normal people. I think there's a misconception that all investors are kind of just writing down the maths on a notepad and working it all out. Obviously some are, but just as many are emotional people, or people who want to believe in, they just want to see customer value, or they just want to see a good market, or they just want to see a founder with loads of ambition. So, I think everyone's different. I doubt many people make a snap decision. Just make sure you're being clear so that, and you don't just want cash, you want, how do you decide if you want an investor during your pitch is the other question. What should you be looking out for from them to decide if you want to take their money? But I think people don't think about that so much. They're all trying to sell upwards.
It's like a pitch date.
Yeah, it's cash for equity. It's not, you're not asking for a favor. It's a business thing. So, one thing you need to get away from is, whilst you should be absolutely respectful, especially if they've been successful in this field, but you're not asking for a favor or a charity. You're asking for an investment for equity, and you want the right partner as well, which means the same thing. What are you thinking about them? Do you judge the way they interact with you, the impression they give, the way they speak? Do you trust them? It's kind of the same process in many ways.
Yeah, definitely. That sort of answered my next question then, but maybe you could offer maybe a couple of points as to what Nova's investors specifically look for in pitches. So maybe just to summarise.
Well, what we at Nova look for is a good founder. So that means they can articulate a market and a customer segment really well. They're outward facing, so they're happy to do sales and get their hands dirty and speak to customers. They probably have got some good early stage traction, so they've done some sort of creative experiment, or they've used some very limited resource to validate part of their concept, which is really great for us. We love it when someone is kind of thrifty and frugal, yet they're proving things in their company so they can raise money later. And we also look at that market as well. Is the market growing? We wouldn't even, no matter how good a founder was, we wouldn't really be interested in funding a petrol car company today, because it's just so blatantly obvious that that's not going to be the future. So you always want to have growth on your side. So best, is it a good market? Is it a good founder? Does their plan seem sensible? But that's not, a lot of people pitch this is going to be the product, this is going to be the plan. We're looking to add value into those elements. So, that's what we're looking for.
Cool. Okay then. So by accident last week, I asked Paul what his top 5 takeaways are. So I'll try and phrase this correctly this week. But from this session,
Takeaway, five guys, definitely.
oh, that's a bit of a rogue decision, I feel.
No,
Oh,
five guys.
okay. So Paul's
Yeah.
was Wagamama's, yours is Five Guys. I feel like I'm going to have to ask this question each week now. It's going to be like a
Five guys.
thing. But what are your top 5 takeaway points from this session? So, in summary.
Um, okay. Number one, I think try and figure out who you're pitching to. Like, you might as well spend 20, 30 minutes doing a bit of research. What type of businesses are they interested in? Can I speak to them a little bit more informally before going through that process? Don't just send your pitch deck cold. Like, it's not going to help you raise money very, very frequently. So point one is, like, before you've even worked on your pitch, think about like your overall approach and strategy and what strengths you have. Are you better going through the front door? Are you better going through the top? How do you speak to people? Secondly, just keep it simple. Like, most investors are there to make an investment as long as they hear the things they need to hear. If they don't hear the things they need to hear, they'll likely ask you about it. And actually, if you can then answer with more compelling evidence than was in your pitch, then that's great. So it's much better to err on simplicity than it is to go trying to go make it too complex and difficult. And that involves avoiding words like AI and machine learning. If you can, just explain it before that, and then if they need to get into the detail, you can. The third thing is, and I know there was a question, but I don't think we covered it, but a lot of people say to me, "Oh, I need more than 10 minutes to pitch," or "I need, more than 5 minutes to pitch." It's not about selling the whole startup in 10 minutes. Again, they're not going to decide to invest in you or not just off one pitch. It's going to be much more important the overall engagement with them. So it's a bravery to know what to leave out. It's a confidence to know what to focus on and what's not important. And it's only something you can do if you actually understand what you're talking about, so you know what you can and you don't need to. What I would say to anyone who says I need more than 5 or 10 minutes is there's been presentations that have won Nobel Prizes for science that have taken about 5 minutes. I think the double helix one took about that long for DNA. So if they can explain that in 5 minutes, I think anyone can explain a business in 5 minutes. And to be honest, in my experience, most investors don't have more than 10 minutes of paying attention in them, because that's 10 minutes of like building up questions and assumptions, and there's no point in me listening to the end of this presentation because I don't agree with what they said at the beginning. So I'm going to have to go and add that, so then I can work past that and through it and get to these bits. So by adding more, you actually give yourself more opportunity to say the wrong thing. So that'd be like the third point. Trying to think of the other two. Don't spend, the deck isn't as important as people make out. Just make sure it's clean and simple. That'd be the fourth one. And fifth one is, I think when you engage with a VC or an angel, it is two-way relationship. So before you take money or before you ask for money, why not have a couple sessions talking about strategy, coaching, the business? It's a really important decision that people are in fact a big rush to make, and also think will happen very quickly when typically people need to get comfortable with each other. So feel free to engage on your terms, because if they're not willing to, then is that the person you want to work with?
Fab. Well, thanks for that, Luke. We've got 3 minutes to go. So if anyone's got any last minute questions, pop them in the comments now. But yeah, if there are any questions that we haven't covered over this session, like I mentioned at the beginning, this video will be posted in the group. So you can just add your question to the bottom of the comments, and we'll just log back in and we'll answer them for you in the comments. But yeah, other than that, thanks for that today, Luke. That was really good.
You're welcome. Thank you.
That's all right. And I think next week we've got Paul Millward, who will be answering all your questions on like investment. So he'll be going more into like the nitty gritty side of investment. But yeah, so thanks for that today, Luke. Enjoy the rest of your day. I hope you get 5 guys.
See you later.
Right. See you later.